It doesn't look much like a bank, but today Downing Street and so we the taxpayers have become the biggest shareholders in these high street names. It's also a huge investment in the country's future. The banks may have been saved, but the Prime Minister was keen to insist it's not free money.
The action we are taking is unprecedented, but essential for all of us. It is not just important to economists and financial experts, it's something that matters for every family and business in Britain. In extraordinary times, with financial markets ceasing to work, the government cannot just leave people on their own to be buffeted about. For savers, for small businesses and for homeowners, we must, in an uncertain and unstable world, be the rock of stability upon which British people can depend.
To bolster confidence in the banking system, the government forced the banks to drastically increase their reserves by buying shares in them using taxpayers' money. It's made £37 billion available to three of the country's biggest banks. RBS will need 20 billion of that, twice its stock market value, giving the taxpayer a 63% share. The government is not expected to buy shares in Lloyds TSB until after its merger with HBOS, and then it will get £17 billion from the nation, giving the taxpayer a 41% stake of the newly merged bank. David Cameron had misgivings, but was forced to support the government's move.
This is necessary but painful. It needs to be done, but it's expensive. And in some ways, it's paying the bills for the last 10 years of excessive debt.
Here in the city, the news of the bailout plan got initial approval. The market rose, the screens covered in blue for buy signs compared to last week's sell-off. But the real question is, how long will it last?
We're feeling a little bit happier today. We have got that sense of euphoria. The market is boosted higher today, both in the UK, European markets and the US after the open as well. Hopefully this is going to continue throughout the rest of the week and we can start kick-starting these markets again.
For the city watchdog, the Financial Services Authority, it was worth over-engineering the plan to make sure as far as possible that it doesn't happen again.
The way that we have decided to put that right is to build up the capital of these banks to a level which is way, way beyond our classic standards and the international standards, and to combine that with guarantees of their debt and promises of Bank of England liquidity, which makes it absolutely certain, first, that these banks are sound, and secondly, that they are in a position to lend money to the real economy.
And for British business, the whole operation was necessary for the health of UK PLC.
I think it's not just well needed, I think it absolutely is the start of the cure. I think the operation, as I keep saying, is over, and I think now it's about that recovery side. And I think that all SME businesses in the UK shouldn't be necessarily celebrating, but they should be sitting there thinking, thank goodness.
It is just a beginning, but the hope that other European countries would adopt similar plans and that the US would continue to support its banks gave a rare positive note to the day. But the real success of the scheme will be when lending between banks has unfrozen, and these are still early hours.